It's almost the end of 2023. And amid increasing gun violence, there's another phenomenon on the rise in the US. We're talking about bankruptcies. Corporate bankruptcies in the US are reportedly set to hit the highest level since 2020. Meanwhile, another report released by the United States in October showed that business bankruptcies rose nearly 30%. That's in the 12 months that ended in September this year, as when compared to the same period last year. This year saw some of the biggest and legacy brands collapse. Let's begin with the most recent. No one is alien to the saddening but imminent downfall of WeWork. WeWork went down almost as quickly as it rose. Once a near-invincible unicorn, WeWork came crumbling down in November this year. But WeWork's demise started years ago. In 2019, all was rosy under its founder and CEO, Adam Neumann. It was a $47 billion company. This was the year when WeWork filed for an initial public offering or IPO. And while most investors waited for a peek into the company, almost immediately all hell broke loose. Neumann was accused of mismanagement and bad behavior. Within just the next 33 days, WeWork underwent mammoth changes. The IPO was scuttled. WeWork's valuation plummeted by more than 70%, and Neumann was ousted as the CEO. In the years that followed, WeWork made a series of challenging and arguably bad decisions, and that marked an end to the embattled firm. Evergrande is a name that has become synonymous with China's failure. At one point, Evergrande was China's second largest property developer, with more than 1,300 real estate projects. But it all came crashing down from 2020. In 2020, China brought in new rules to regulate the property sector, and that was perhaps the beginning of the end for Evergrande. In 2021, it all came crashing down. Evergrande missed crucial debt repayment deadlines. It was facing a liquidity crunch, and then finally it was declared a defaulter. Now, with around $300 billion in liabilities, it stands at the center of China's property crisis.
I think the government can help, but first Evergrande must save itself. Only after it has rescued itself, the government can come up with a proper solution. It should not be the case that Evergrande only makes money but then asks the government to save its life.
Evergrande's fall opened up a Pandora's box of issues. The property sector accounts for roughly a quarter of China's economy. And the property bigwig's fall became one of the predominant reasons for a decline in the Chinese economy. In August this year, Evergrande filed for its bankruptcy in the US. It's a Chinese firm, but the company filed for bankruptcy protection to secure its US assets. America's retailer Bed Bath & Beyond suffered a rather tragic decline. The half-a-century-old retailer rose to fame in the 1990s. It was America's go-to shopping destination for home goods. But in April this year, it filed for a bankruptcy. However, Bed Bath & Beyond's failure was not really surprising. In fact, in January of 2023, the company had issued a concern, a warning that it may not be able to continue operations. This briefly jolted financial markets. But it was not until April that the gravity of the warning was realized. There are a number of reasons that contributed to Bed Bath & Beyond's fall. For one, quite simply put, customers did not buy their products. Then the rise of online marketplaces also weighed heavily against the retailer. Not enough money was flowing in. The company's costs surpassed its revenue, and the firm could not secure funds to stay afloat. That perhaps was the final nail in the coffin for the beleaguered retailer. March this year brought a whirlwind for America's financial sector. America's banking sector was rattled throughout March. Banks collapsed one after another, worried customers rushing to withdraw their funds, and a hullabaloo of consecutive unsettling events. Much of it began with the fall of the SVB Financial Group.
So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run.
SVB Financial's bankruptcy was ignited by the fall of its subsidiary, Silicon Valley Bank. Silicon Valley Bank was taken over by federal regulators after its investments greatly decreased in value. SVB became the largest bank to fail since Washington Mutual closed its doors, and that was amid the 2008 financial crisis.
Well, look, we invoked this systemic risk exception because Silicon Valley Bank had experienced a calamitous run, a run that was so enormous that it overwhelmed the liquidity of this bank, its ability to arrange liquidity. And it created the potential for fear about the safety of uninsured depositors in many other banks, and a failure to protect those who were uninsured depositors in this bank.
And no sooner than Silicon Valley Bank was taken over, its parent SVB Financial collapsed. The fall of SVB Financial was shortly followed by Signature Bank and First Republic Bank, all within less than 2 months. As we approach towards 2024, the wave of bankruptcies is likely to stretch on to the coming year. However, analysts expect the pace of filings to slow down. The US Federal Reserve has said that it's unlikely to hike rates further, and that perhaps will offer some respite to the companies.